To me, the chances of Bitcoin having a huge fourth quarter are really high, and not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year. I'm sure there'll be 50% drawdowns because the stock market has more frequent 25% drawdowns. I mean, that's when, even though people realize, I mean, the stock market's made a lot of progress last 6 years, we've had an unusually large number of 25% drawdowns. And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40. If we're measuring bubbles based on like risk reward, we're pretty far from it.
Tom Lee draws a clear historical parallel. Bitcoin tends to follow gold's lead, often lagging its moves by several months. When gold rises, it signals a broader investor appetite for non-sovereign stores of value. And Bitcoin, being the digital version of that thesis, eventually catches up. If gold's network value rises, say stabilizing around $5,000 per ounce, that could push Bitcoin's fair value as high as $1.6 to $2 million per coin, assuming parity in store of value utility. But that's not just theory. Lee believes conditions are aligning for Bitcoin's next major move as soon as this fourth quarter. He points to several macro catalysts.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I mean, there's a lot of reasons gold probably is going up. And at Fundstrat, we don't do commodities. I kind of regret not recommending gold because it's been so great. I mean, because, like generally, I like to be helping our clients be involved with things that are going up. So I think gold's move is like...
It's a good strategy.
Yeah, exactly. I don't want to fight it. And like,
what kind of business do you have? I help our clients' portfolios go up.
Yeah. So gold's been amazing. I think what's really stood out is that you can explain gold's move by just pure technicals. Like I was talking to our technician, Mark Newton, yesterday, and he says that gold had a cup and handle pattern that the breakout was July of this year. And so the measured move should have taken it up to where it is now. But let's say price leads fundamentals. I think that July is also the time that the stablecoin industry started printing a lot more creations. And as you know, there's been gold stablecoins and dollar-based stablecoins, but a lot of the dollar-based stablecoin issuers are over-collateralized. So I think the stablecoin industry has been printing a lot of dollars, they're over-collateralized, and I think they've been buying a lot of gold.
Interesting.
So I think that the stablecoin industry has been the newest bid for gold.
More so than even like a China central bank?
Yeah, because they've already been present. The central banks have been present for some time, but there's somebody new buying gold on top of the retail buying gold. And I think that would be my guess, because like I've now there's like 7 or 8 gold stable coins.
Yep.
Plus there's big stable coin issuers, and so that could be the bid to gold. Now, does that mean gold is unlimited on the upside? I don't know. I mean, I'm not studying it, so I don't know. But I think it's very bullish for Bitcoin and Ethereum because...
Why?
Well, gold moves first, and then Bitcoin catches up. So I think that there is going to be the network value of gold just went up by a lot. And so let's say gold settles at 5,000. That puts fair value of Bitcoin, like 1.6 to 2 million if it matches gold's network value. So I think it's actually helping Bitcoin's future terminal price. As you know, Bitcoin makes its move in 10 days a year. So are Bitcoin's best days in the fourth quarter? Probably, because we have catalysts, the Fed's easing. We have a shutdown that's been risk off. We have China-US tensions that, look, every time there's a headline on China, like Bitcoin takes a gut punch, right? Because it is money flows and deleveraging. So that goes away. We have seasonality that favors stocks moving up. Stocks moving helps Bitcoin. So to me, the chances of Bitcoin having a huge fourth quarter are really high. And not all of these would be tailwinds for gold. So I wouldn't count. I still think it's possible for Bitcoin to hit 200,000 by the end of the year. Most of the crypto people I speak to expect a 4-year cycle. and they're adamant, that maybe Bitcoin peaks early next year. But as you know, when something is so strongly held, it's very unlikely to be true. So either Bitcoin's already peaked or we have a longer cycle. I'm more in the camp that it's a longer cycle.
But there would still be 50+% drawdowns in the future, or there's a kind of cycle is broken and you get something different?
Yeah, I'm sure there'll be 50% drawdowns because the stock market has more frequent 25% drawdowns. I mean, that's when, even though people realize, the stock market's made a lot of progress last 6 years, we've had an unusually large number of 25% drawdowns. And we probably have another S&P decline of 20% next year. So if the S&P is down 20, Bitcoin could be down 40. I don't really have an idea of what the following year looks like until early December, because then we're only 1 month left in the prior market. Because this year, for instance, I think S&P gets to 7,000, right? But if we get to 9,000, then it pulls from next year. So, so price being a little unknown, I think there's a lot to be optimistic about in 2026 because one, monetary policy is easing, and that's room for mortgage rates to come down. And we know there's a huge pent-up market for not only housing to become more affordable, like through allowing capital to build cheaper homes and stuff, but for people to have relief from mortgages. The ISM, which is the benchmark of manufacturing confidence, has been below 50 for 32 months, the longest stretch in history. But once the Fed starts cutting, companies can get more confident. So the ISMs recover. That's great for the US economy. We know there's onshoring next year. That's GDP activity. And then AI, I think, is becoming, as you just pointed out, like robots, agentic, superintelligence. These are huge innovations coming next year that are good for earnings growth. So I think the earnings picture looks good. But how much is reflected in the stock price, we don't know yet. Like if we exit this year at 7,000, then there's plenty of room for stocks to do well next year. If we end the year at 8,000, then we're going to have a 30% drawdown. If we're measuring bubbles based on like risk reward, we're pretty far from it, because in 1998, September, which is similar to today because the Fed was on pause and then they started cutting again September 98, Cisco, which was the biggest company at the time, was trading at 56 times forward PE. 18 months later, it got to 210 times. Now, Cisco made a commodity router that had many competitors. NVIDIA today is the singular most scarce company in AI. They make a chip that everyone who is building a premier model needs. It's trading at 27 times forward earnings. Costco trades at 50 times forward earnings, and Walmart's 34 times. So NVIDIA is still cheaper than a membership club company. So I'd say that's why we're pretty far from a bubble.
Tom Lee then takes a step back to look at the big picture. Despite 6 major black swan events since 2020, including COVID, the supply chain shock, runaway inflation, the Fed's fastest tightening cycle in history, and geopolitical crises, corporate earnings still grew. In his view, that makes the modern stock market battle-tested. Far from being fragile, it's proven capable of adapting and thriving even under extreme stress. That resilience, he argues, justifies higher valuations, not lower ones. And when you consider that most of today's earnings come from recurring revenue models rather than cyclical industries like in past decades, the case for a structurally higher PE ratio becomes even stronger.
6-year period since COVID, earnings delivery has been amazing.
So substance has been there.
Yeah. So like even this quarter, 85% of companies are beating results right now. And it's still going to result in basically 15% earnings growth. So that's not late cycle earnings growth. Late cycle would be single digits. So companies are still finding ways to grow margins and earnings. And there's plenty of multiple expansion. Financials, business results look more like tech companies now, but they still trade like financials. So I think there's a lot of groups that can re-rate. I can empirically show it's the most hated. One of the best measures of large investor sentiment is the AAII Net Bulls Index, bulls less bears, because it's been run for 40 years. This year, it's averaged minus 11.7. So every week, the weeks through this year. there's only 3 other times in the last 40 years it's registered negative 11.7. 1990 or more, 1990, 2008, and 2022. All were bear market years. So sentiment reads as if we're in a bear market and the market's up 15% year to date. Why is it the most hated? I think we show this in our research that it's based on political divide. So the country is 50-50 Republican Democratic. But in the stock market world, and there's Pew Research data on this, 57% of professional money managers are Democratic. 66% of hedge funds are Democratic, and something like 69% of venture capital funds are Democratic.
Interesting.
So the risk capital world didn't vote for Trump. So they view his policies as that of someone who is destabilizing to the economy. In the bond market, it flips. 80% of credit managers are Republican. So that's why this year the bond market hasn't been, high yield spreads have been stable, credit spreads have been stable, but the stock market's been volatile. How many economists have said, oh, tariffs are going to cause a recession, or tariffs are going to cause an inflation surge? That is actually a very subjective argument, because tariffs are a tax. And if we treat it as a tax, taxes are not inflationary. So we'd never say it's inflationary. But the economists who are portraying it as inflation are, I think they're taking a specific view that makes it an inflation argument. So in other words, there's some sort of bias in that statement. People are willfully overlooking that valuations are actually, they're dynamic. You know, from 1940 to 1967, the 10-year went from 2% to 6%. And everyone should say PE should have fallen in that 27-year period. The PE went from 8 times to 27 times. So in other words, as nominal rates rose, earnings accelerated, and so the PE went up. And that was in a time when 70% of the earnings generated were cyclical. Today, most of the earnings is recurring revenue in the S&P, which is higher multiple. And in fact, the 10-year bond is at 4%, it's at 25 PE. I mean, the bond market's expensive. So, so I think you're correct. I mean, plus in the last 5 years, we had 6 black swans. We had COVID. We had the supply chain bullwhip effect. We had an inflation bubble, the Fed's fastest hikes in history. We had the tariff terrors and U.S. bombing Iraq's nuclear facilities. 6 black swan events. And the market grew earnings during that time. I would argue PE should be higher because we just battle tested the stock market.
For years now, I've been hearing folks who I would put in, they grew up in the stock market, they're kind of legacy system, supporters and participants. They don't really get the Bitcoin and crypto thing. They have forever been saying, you guys don't understand, there's a big crash coming there. You don't know what a real market downturn is, whatever. And I always just think, I'm like, do these people realize that the people holding Bitcoin have seen 2 drawdowns of over 80% in 4 years? That's never happened in the stock market.
Yeah.
Right. And so like in this crazy way, actually the crypto people are more prepared for market volatility than the stock people. But it's like, if you haven't like gone through the pain, you just don't think that exists or something. Right. And like the stock people don't acknowledge the fact that you kind of had to be insane to hold to all the volatility in crypto. Yeah.
And actually what I've noticed, and it's not true of but I've met some crypto skilled traders, and a percentage of them are exceptional equity traders.
Interesting.
They've become so good at the EQ of like market moves that they're great at stocks. Not every crypto trader, because a lot of crypto traders are just, degens, but so it really does cross over. I think being good at stock investing is not a skill that's learned at Harvard. Some people are just really good at it.
Well, to me, I've always thought the crypto market is much more of a pure free market kind of macro thing as to how it was originally designed. There's no hours of operations. There's no circuit breakers. These less algorithmic trading. It's just like very, very much how markets, I think, used to operate maybe 40 or 50 years ago. Correct.
A true over-the-counter market.
And today, the stock market is not that. And so you kind of have to pick up the skill in a pure market, and then that makes you better at the somewhat manipulated game.
Yeah, so I found some really some crypto guys are really even good at timing the market. They've been getting out at the right time. So it's
Well, they're definitely good at recognizing the bank run. So every single crypto person who had money in Silicon Valley Bank, they got it out for sure.
Yeah.
What is your read on the retail activism campaign and kind of the a business like that where you've got all the real estate kind of intersecting with monetary policy that's easing?
Yeah. I mean, I'm rooting for Open Door to work. I haven't done the work. I mean, I'm a fan of Eric Jackson. I think he's really thoughtful guy. I mean, first of all, he nailed the Carvana a couple years ago. So I think Eric's very smart. Open Door, I don't know the business model. I think what I understand to be is like you buy homes and you're selling it. So that I don't have expertise. But the idea that that the shareholders can try to get the company to wake up and then change their business model, I'm all for that. That's what activists do. And so I'm rooting for it to be successful. I haven't done the work, so I don't know.
Yeah, to me, it probably is the most successful activist campaign in recent memory, right? I mean, I don't know of an activist who's been able to get the CEO to quit, got the management to stop selling shares, bring in, the former CEO of Shopify. You just like go through all this and you're like, maybe the whole thing was don't have one person go activist, have like a group of people.
Yeah,
right?
and it's all doing good things for shareholders, right? Because you're taking what's maybe a good structure of a company. I'm just saying I haven't done the work, so
of course.
But
But do you think we'll see this more? Like as the retail investors get more capital and almost get more confidence, do you see that this kind of becomes a trend where they start to pick companies and actually advocate for change?
Yeah, I think if
Lee comments on a growing phenomenon, retail investor activism. He references the case of Open Door, where a group of individual shareholders successfully pressured management to change leadership and strategy, something unheard of just a few years ago. Lee supports this trend, calling it shareholder democracy in action. As retail investors gain confidence and capital, he expects more such campaigns, a sign that financial participation is broadening beyond traditional institutions. In the long run, that could make markets more dynamic and accountable to their owners.